In this video we are going to talk about dividend stocks to buy now. So before starting, please like this video and subscribe to this channel for future updates. Most income investors buy dividend stocks based on the current dividend yield and payment history of the company. They make their decisions based on previous tendencies, hoping that the dividend gravy train would continue to run even if the economy tanks. But let's face it, the past isn't necessarily a foreshadowing of the future. As a result, if you're looking for secure dividend investments, you need look beyond yield. After understanding that dividend growth, not yield, drives outperformance, Reality Shares developed a system called Dividend, short for dividend condition, that uses multiple indicators to pick safe dividend equities. Expected dividend growth, free cash flow to dividends, earnings per share, EPS, growth, recent dividend actions, and the Altman Z-score are among the Dividend criteria used to evaluate a company's dividend health, which gauges the likelihood a company is going bankrupt. Companies are given a Dividend score ranging from 1 to 100, and then a Dividend rating ranging from 1, most likely to cut, to 5, least likely to cut, most likely to increase. What is the implication? The highest scoring equities should be among the most secure dividend payers. Number 5. Hershey HSY, $180.19, has a sweet story to tell when it comes to candy manufacturing. This famed American business not only makes the classic chocolate bars that bear its name, but it also makes Reese's, Jolly Rancher, Almond Joy, Cadbury, Kit Kat, Heath, Rolo, Twizzlers, Bubble Yum, Pirate's Booty, and other confections. It's no surprise that it's one of North America's largest chocolate producers. The company's headquarters are in Hershey, Pennsylvania, where visitors can experience the magic of Willy Wonka's world. There are street lamp posts styled like Hershey's Kisses. Hershey's Chocolate World is a museum and children's attraction. The Hotel Hershey Spa offers whipped cocoa baths and chocolate fondue body wraps, and Hershey Park is a theme park with thrill coasters, among other things. Dividend investors, on the other hand, should pick Hershey for similar reasons. It has a flawless Dividend 5-year dividend score of 10, showing 5 rises in 5 years, and an incredible Altman Z-score of 7.0, suggesting great financial soundness. Plus, in July, this dividend stock increased its quarterly payout by 12.1%, making it one of the safest dividend stocks. It certainly didn't help that the company's second quarter earnings and revenue beat analyst projections. According to Zacks Equity Research, sales increased as customers enjoyed more sweets at home, but revenues from its away-from-home segment and international markets also grew. Lily's Sweets, which specializes in better-for-you confections, was recently acquired by Hershey as part of the company's plan to expand its business in this sector. This transaction is expected to generate profits for management, adding to an improved net sales projection of 6% to 8% for 2021, up from 4% to 6% before. Number 4. Stanley Black & Decker. Stanley Black & Decker, SWK, $187.57, is best known for its domestic power tools, but it also sells industrial equipment and provides security services. SWK said in August that it will buy the remaining 80% ownership in MTD Holdings that it didn't already own for $1.6 billion in cash, expanding its product line globally. Under the brands Troy-Bilt, Rover, Cub Cadet, Remington, Yard Machines, Columbia, Wolfgarten, and Robomo, a robotic lawn mower that works like a Roomba for lawns, MTD makes commercial and personal lawn mowers and other lawn maintenance equipment. In 2020, the combined firm will generate $17 billion in revenue, $2.5 billion for MTD, and $14.5 billion for Stanley Black & Decker. According to a recent study by UBS analyst Marcus Mittermeier, the acquisition will be extremely accretive to earnings, and management's prediction of $1 plus per share in profits by 2025 is conservative. Furthermore, he claims that the stock is cheap. After the company produced strong second quarter earnings that exceeded Wall Street's forecasts, the analyst reiterated his buy recommendation on SWK. According to consensus price to earnings for the next 12 months, Stanley Black & Decker is trading near a 10-year low versus the S&P 500. He believes the stock will return to its previous levels. Stanley Black & Decker is likewise rated by Deutsche Bank analyst Nicole de Blaise. She writes in a recent report that it is excellent to see the accompanying EPS accretion locked and loaded for 2022 forecasts, and that management has been telegraphing its plans to buy the balance of MTD for some time. Number 3. Evercore. Evercore EVR, $163.18, is a private investment banking and advising firm with a wealth management section that managed $11 billion in assets as of June 30. Evercore said it grew adjusted EPS at a compound annual growth rate (CAGR) of 24% and adjusted net sales at a CAGR of 13% over the 5 years ending in 2020. The secure dividend stock has a buy rating from Zacks Equity Research. Evercore has an excellent track record of producing higher than expected earnings, according to the firm, particularly in the last 4 quarters. Evercore's initiatives to strengthen the investment banking division are a strategic match, according to Zacks, given the positive macroeconomic background and improved market circumstances. They say that stable market conditions, low interest rates, and extensive financing availability could keep its M&A activity elevated in the coming quarters. Additionally, Evercore's attempts to increase the number of advisory services clients as well as geographically extend its business have resulted in strong revenue growth. EVR has a lesser likelihood of defaulting on its debt, according to Zacks, due to the company's good cash position. Zacks warns about 2 potential headwinds: growing employee compensation and benefits, which could impact the company's bottom line, and a drop in assets under management due to currency fluctuations, which might hurt fee income. Number 2. United Parcel Service. United Parcel Service, UPS, $195.27, is one of the market's safe dividend stocks when it comes to dividends to shareholders. Consider that the business paid $3.6 billion in dividends in 2020 as the pandemic raged, up 5.2% on a per-share basis from the previous year. UPS paid $1.7 billion in dividends to shareholders in the first half of 2021, aided by the fact that the firm generated $6.8 billion in free cash flow, up 75% from the same time in 2020. UPS's anticipated dividend growth is 10%, while earnings per share growth is 120.6%, and the company has a perfect 5-year dividend score of 10. The Altman Z-score for UPS is 4.6. 3 or above signals strong financial standing. UPS increased their quarterly dividend by 1% in February. The corporation made it plain that it is committed to paying out dividends. One of UPS's key beliefs and a hallmark of the company's financial health is its commitment to the dividend, says CEO Carol Tomé. UPS aims to pay out 50% of the prior year's adjusted net income in dividends beginning in 2022, she says. Number 1. HP. HPQ, $28.59, not to be confused with sister company Hewlett-Packard Enterprise. HPE is where one of Silicon Valley's early granddaddies, the erstwhile Hewlett-Packard, housed its personal computer, PC, and printing businesses. HP and HPE were formed when Hewlett-Packard was split up in 2015, with the latter focusing on servers, the cloud, storage, software, and other services. While selling PCs generates greater revenue, about 2/3 of the top line, it only contributes for half of HP's operating earnings. The printing industry is lucrative, especially when it comes to selling supplies. And, over the years, HP has held its own in the PC market, albeit with a dimmer long-term outlook as mobile devices become more prevalent in computing. According to Argus research analyst Jim Kelleher, HP's revenue increased 7% to $15.3 billion in the third quarter from a year ago, although this was attributable to strength in printing rather than the PC sector, which was unchanged by. Despite this, the company achieved high free cash flow, FCF, in the quarter, which is the cash left over after a company has paid its expenses, debt interest, taxes, and long-term investments to grow its business. HPQ also revealed during a recent Analyst Day that it would increase its dividend by more than 28% to $1 per share. In the long run, Kelleher believes that the current hybrid model for working, learning, collaborating, and socially interacting will benefit HP as a permanent state of things for consumers, enterprises, and institutions. HP is well positioned in this new normal given its PC and printing operations, he adds. With strong earnings per share growth, a high free cash flow to dividend ratio of 602.7%, and a perfect 5-year dividend score of 10, HPQ has earned a spot among these safe dividend companies. What do you think about our video? Let us know in the comment box below. Please like this video and subscribe to this channel for our future updates. Thank you.